It's my honor to moderate the final panel, which will focus on recommendations for regulation of the industry going forward. Our panelists are Paul Kupiak, who's a resident scholar at the American Enterprise Institute, Barbara Novick, who's vice chairman and one of the original founders of BlackRock, and Marcus Stanley, who you've heard from briefly, policy director at Americans for Financial Reform. You have their detailed bios in your packets, and we're running out of time anyway, so without further ado, let me turn the podium over to Paul.
First, I'd like to thank Doug for inviting me, and the other organizers. These are always great events, and today is certainly another one of them that's stellarly interesting. So, if you go through all the reports that have happened since the crisis, the Financial Stability Board, the OFR's Asset Manager Report, a couple of BIS presentations, New York Fed papers on the topic, and the Christmas Eve release of the questions that we just went through, there's sort of a number one problem. If you have to go through there and there's this constant drumbeat in the background in all these papers about we need more regulation for asset managers, but where's the market failure? And so if you had to go through all these things and distill all these things, and I did, and I think the number one problem, if you were the old, Carson, pull the thing out of your hat, is it's really asset fire sales. And if you go through this is the number one big overriding problem. There's a lot of micro agency problems, but they could lead to asset fire sales if you believe some of these theories and stories. And so you can go through and there's a list, and I just sort of, investor redemptions could lead to asset fire sales. Margin calls could trigger asset fire sales. The gates could encourage fund investors to run and trigger asset fire sales. Securities lending could boomerang back on you and you end up in a fire sale. Pressure on managers to stay fully invested. They're not liquid enough. They could trigger asset fire sales. So there's asset fire sales all over the place in these papers. And so you can think about there being two possible solutions to the asset fire sale problem, kind of at a very high level since I only have 5 minutes. And I think the first solution, and this is the solution that really the FSB and the bank regulators really, this is the way they think, it's we should really impose bank-like regulation and oversight to reduce the probability of investor runs or the possibility of investor runs. This is sort of the resilience argument. Well, if we could just put enough regulation on these things, and what we really need to do is make the regulations more bank-like, more capital, more liquidity requirements, maybe leverage restrictions, maybe minimum haircuts for repo, securities lending, and maybe we should even think about some activities sort of having to be done through banks. Maybe that's the right way to think about it. But I just want to think here briefly that, and I missed the slide. Sorry. There's another possible solution that maybe the government could provide a liquidity backstop, and this was already brought up before, so thanks very much for that earlier, to prevent the fire sales from ever happening. And before you go there and cringe and say, this is a terrible idea, this is horrible, how bad, the moral hazard is just incredible. Well, we actually did this beginning in 1913 with the Federal Reserve Act, where we said, you know what, commercial banks really need a lender of last resort for commercial loans. And that's what the Federal Reserve, one of the primary goals of the Federal Reserve in 1913. And then in 1916, Congress did the same thing for institutions that lent to farmers. They said, what we really need is a liquidity backstop for these guys. We need a lender of last resort. And there was the Farm Credit Act that was created back then, and the Farm Credit Administration was created by an executive order in 1933. And in 1932, Congress did this for savings banks, insurers, and other firms that held mortgages, because banks back then didn't hold mortgages, and they weren't members of the Federal Reserve, or not banks, S&Ls, savings banks, and insurers. And Congress, because it was in the middle of the Depression and there was all these problems with liquidity and mortgages, and people weren't getting mortgages because these institutions couldn't fund them, they needed a lender of last resort, and so they had the Federal Home Loan Bank Act, and we still have the Federal Home Loan Banks today. And in fact, before the financial crisis, there's some famous academic papers out there that show that really before the Fed started its special lending operations, the Federal Home Loan Bank was really the lender of first resort, and it wasn't until late 2008 or 2007, when I guess more 2007-ish, when they started some of the special lending programs, that the Fed sort of took over the lender of last resort function. But in the early days, it was really the Home Loan Bank. So let me talk about this. So I'm going the wrong way, aren't I? Some people would say, yes, you are. So which of these solutions is better, okay? So regulating asset managers like banks would limit consumers' investment opportunities. There's really no evidence that I know of that government regulators can really pick good investments. And yes, this is really kind of the power they're seeking. They want to restrict what asset managers can do. They want to direct investment in the economy at some level by putting restrictions on. This is going to have a growth effect. Economic growth is going to suffer if investors can't pick the right. Well, there's two views to this, right? If you think that people that invest in asset managers really cause bubbles and misallocate resources, then maybe the government shutting it down is a fine thing. I, on the other hand, think investors are the ones that actually pick out the good investment projects, and limiting their ability to do that is probably a bad thing. So I think economic growth would suffer. How much trade-off do you want? So what's the financial stability trade-off? Is there really this promise of financial stability if you restrict it down? What are the growth effects? Is it really, are we really going to get stability out of this? I kind of wonder. But that's sort of the deal there. But anyway, asset manager rates of return are going to be forced to converge really to bank products because they're going to be more regulated like banks. They're going to have bank-like regulation. And so, and regulators would be the first to jump up and discourage high-yield products. And you've kind of already seen charts like this. Isn't it terrible? People want yield on their savings, and wouldn't they be better off on safe things? And this could cause risky products. And I, for one, like yield, and I've been missing it a lot for the last 10 years. But anyway, what's the downside of a liquidity backstop? So if a liquidity backstop is designed incorrectly, it will cause moral hazard. So you don't want the asset managers to use liquidity backstop in place of sound liquidity management. I got that. So it's all about the design. It's all about the design. They must charge for the liquidity insurance, and it must be too expensive to use regularly. Now who might provide this? Now, everybody's going to say right away the Federal Reserve, and I've said that before. I think there's ways the Federal Reserve could be required to sell liquidity options that are available to the asset manager industry to backstop things like tri-party repo. So if that were to melt down, there would be a lender of last resort. But I think there's another possible lender of last resort, and I think you could expand the Federal Home Loan Bank Charter. Home loan banks exist today. They've never lost a dime lending on very risky mortgages. Remember, this is a GSE that has lent to the worst of the worst in the S&L industry. They've never lost a dime. Okay? I think it would be interesting to think about expanding their charter so that asset managers, the funds, not the managers actually, the funds, could belong to home loan banks. They would have to have stock in home loan banks, and they could either get advances, they could liquefy things if there was really a danger of asset fire sales, or the home loan banks could be encouraged to develop liquidity insurance products. Now, there's a couple of different features here. If the Federal Reserve sells this, it's really could affect monetary policy. It's back to the government. The home loan banks are a mutual system, and so losses in the home loan banks would be shared at the home loan bank level. They would recognize the losses, and so there is a little bit of difference in the way the losses are shared here, and the home loan banks are a little bit more like a mutual insurance system than would be the Federal Reserve program. So let me just stop there and turn it over. Thank you.
Sarah here on the slide. So first of all, thank you, Doug, for inviting me. I'm not quite sure what provocative thing I can say after that presentation, but I'll try. I'll do my best. Let me go quickly here, given the time constraints. First thing is, 2015 is not 2008. And as policymakers, I would find it refreshing to both take credit for the work they've already done and take responsibility for the implications of the work they've already done. So, for example, very quickly here, the banking system is stronger. That's a good thing. Central clearing makes that market more transparent and stronger. That's a good thing. The SEC and the OCC have updated the rules for cash pools. That's a good thing. Managers of alternatives are registering, so you know who to call in a crisis. You have a phone directory, and they're reporting reams of data, which is now being analyzed. All good things. So let's take a moment and celebrate that. But then let's also understand that all those things, as I'm going to talk about, have implications for markets, for liquidity, etc., and let's deal with them, not pretend those actions have no consequences. And of course, when it comes to things like, let's say you own a home, there's always a new project, right? Does anybody have a house that doesn't have a project going on? So while the heavy lifting is over, of course there's going to be cleanup, various things that still need to be done. Of course, as they wind down looking at banks, there seems to be a need to look at something else. The something else is asset managers. I agree questions should be asked. I think that's a healthy process, but recognize that is what's happening right here in this transition. Brian noted this morning, asset managers are significantly different than banks. I'm going to summarize it in two things. Asset managers manage other people's money. It's on their balance sheet, not on the asset managers. And asset managers don't create exposures for taxpayers. Boil it all down to those two simple concepts, and you'll understand why that agency model is so important and why the FSOC statement in July to focus instead on products and activities rather than on firms is actually instrumental to getting at the heart of risk and regulating it in a way that will actually make markets better and safer for everyone. So you need to start by understanding the asset managers, the asset owners themselves. Who owns the assets? Who controls the asset allocation decisions? Who do they work with to advise them for consulting firms? What are their objectives? And very importantly, what are their constraints? There is no scenario I can think of where all of our clients would act in the same way on the same day to make the same investment decision. Some have tax constraints. Some need income. Some are willing to take longer-term horizons. Some have higher risk appetites. There's no commonality, so you can't assume everyone's going to stampede in this direction or in that direction at any moment in time. In addition, McKinsey estimates 75% of these assets that you see here are managed internally by those entities themselves. They don't hire an external manager. So when we talk about fire sales and we talk about people selling emerging market debt or any particular asset class, we have to go back to who owns those assets, why they might be making those decisions, and how that propagates through the system. Many of the risk hypotheses that have been promulgated to date fail to understand these really very basic tenets. And the asset owners here are very instrumental, of course, to the real economy. We've talked today about bank finance versus where would the money come from. We like to call this market finance, not shadow banking. That seems to be catching on, by the way, more broadly. So we put out a memo, and there's lots of things on our website if you want to read lots and lots of papers on all these topics. But we put out a memo a few months ago where we said, you know, while there's a lot has been done, here are 6 categories of issues where there's room for learning more, understanding more, studying it. Maybe more regulation comes out of it, maybe not. I'm happy to say, and I'm thrilled to say actually, the FSOC RFI reflects a number of the areas and issues that we had raised ourselves. Today I only have time to focus on the first 2 bars. One is market structure. Nancy raised earlier the question of market liquidity. So I go back to my first slide. The cumulative impact of regulation of banks means there is less liquidity in the bond markets. I think the deleveraging and all the other provisions is what we wanted. I think that was the objective. But now let's own the results. Now let's think about how can we offset that reduced bond market liquidity. What things can we do? Electronic trading platforms, standardization of corporate bond issuance. There are a whole host of ideas that have been put out there, but let's really look at those and focus on how do we offset safely in good, positive ways that reduced bond market liquidity. Likewise, central clearing. I haven't heard one person talk about that today. We've taken something out of the banks. We've put it in a central spot. These are for-profit entities. They don't have capital. They don't use stress testing. They are not safe the way they're designed today. That is the single biggest systemic risk I can see, I can identify. I know it's there today. I don't have to wait for that future event. Let's focus on fixing that and making that unfinished business from, let's take credit for the beginning part, central clearing, but now let's make sure we put the roof on the house and we nail down all the shingles. And of course, in the equity area, we also need a level playing field. We need a whole day to talk about that. So the second bar, product regulation. I think everyone's talked about it, but we have 2 papers out there on the website. One on fund structures and the interrelation of different mechanisms within a fund structure, the toolkit that a board might have or a manager might have, so that if you had an event, what could you do about it? Let's build the broadest toolkit possible. Likewise, liquidity risk management, the idea that managers are always fully invested. It's just not true. The range of what people do is very different. It's even different within a fund complex from one product to another. High yield is managed differently than emerging market debt, differently than bank loans, and certainly differently than equities. Let's recognize that, let's understand that, and then, frankly, let's raise the bar industry-wide through stress testing and other things on liquidity risk management. And I know I'm almost out of time if I'm talking very fast, Doug. That's the problem being the last panel. So, a couple of quick conclusions. We completely agree. Horizontal regulation, it's the way to go. If you think about at the product level, money market funds, if you regulated 3 money market funds differently than the rest of the industry, what would happen? Money would move from the ones people liked better to the ones people didn't like to the ones they liked better. Activities, same thing, OTC derivatives. If we took the top banks and said, you know what, you're going to be regulated differently than the rest of the banks, then the money would move. People would either do more business or less business based on who they thought was better to deal with, more cost efficient, whatever criteria they used. So you have to do, as we saw in those 2 examples, you have to do horizontal regulation. Same thing is true about all the issues in asset management. And then I also want to touch on, there is a huge need to differentiate between what is idiosyncratic risk, what is market risk, and what is systemic risk. And although we hear often, don't worry, we understand this isn't, we're not looking for market risk, that's not what the questions that then come back reflect. So if you think about the seismic changes that have occurred just in the last couple of months, Japan makes some big announcements about asset allocation shifts and monetary policy. Huge movements in equities. Greece, the elections, oil price shifts. All of these things dwarf the decision I could think of any individual asset manager ever making. So let's have some perspective of what kinds of decisions are made, who makes them, and what is the magnitude. And then lastly, engagement. These are incredibly complex issues, although I've now said it in 5 minutes or less, talking very quickly. And I went over my 5-minute allotment. So I'm off the stage.
Okay, so less than 10 might be more realistic than 5 here, but this is the second time that I've been at Brookings discussing asset management, and the first time was in December 2013, which was, if you recall, a very heated moment in this asset management debate. But since that time, there actually seems to have been some real progress on this issue, which is always a pleasant surprise when you're working in Washington, D.C. And when I'd first like to talk about what I think that progress consists in and the areas of agreement and consensus that seem to be emerging, which I think are going to be evident in these, comparing my presentation to Barbara's as well, but then the very important areas of disagreement that remain for the future. And the best source for the state of play on that emerging consensus is the FSOC release that Patrick discussed, and also the December 11th speech by Mary Jo White, which is really a terrific speech on the SEC initiative. And that speech calls for action in 2 broad areas. And the first is the management of liquidity and operational risk, particularly ensuring the capacity to provide redemptions when a fund or an asset manager is under stress. And the second The second is transparency and reporting of products and positions, both to regulators and to investors. And the FSOC notice adds on, I think, an emphasis on leverage, which I think is actually also part of this emerging consensus. And I think that the commitment to address these areas is just extraordinarily valuable. It's very valuable that there's a broad recognition emerging that the mismatch between promises of liquidity to investors and investments in complex and illiquid products can lead to what are effectively bank runs on asset managers or on funds. And I think that raising the bar on stress testing and operational risk across the entire industry, not just in a few designated large managers, should be extraordinarily beneficial. And of course, there are major problems with the current state of transparency and data reporting for funds, for their positions, instruments, and activities that really urgently need to be addressed. And Nellie talked about that for mutual funds. It's even worse, far worse, for hedge funds and for separate accounts. So that's really something we need to make progress on. Now, these areas of emerging agreement fall into what one might analogize to microprudential regulation, what I would call microprudential investor protection regulation in asset management. That's not microprudential in the sense of bank regulation, in the sense of ensuring the solvency of the entity, because that's a very tricky concept in the case of asset managers, but in the sense that that agenda is about whether a particular individual asset manager can follow through on its commitments to its own investors. There's much less consensus on what might be called the macroprudential aspect of regulating asset managers, the ways in which the actions of asset managers create externalities for other people in the system and can affect broader credit intermediation and secondary impacts on those that are not their own investors. And there's also, of course, less consensus on the hot button issue of what kind of role the Federal Reserve should play as a banking regulator with a systemic risk focus in the oversight of and regulation of asset managers. But before getting into those areas of disagreement, I think it's worth saying that implementing the agenda that the SEC has laid out is probably a really necessary first step to further progress on any of the other areas that we're looking at. Without better data reporting and without the right kind of procedures for stress testing and operational risk management at the level of asset managers, the individual asset manager, it's going to be very difficult to get a concrete understanding of how funds fit into the broader systemic risk picture. And we're going to get lots and lots of those coulds that Mark Flannery pointed to. And there's also a close relationship between micro-level investor protection and broader systemic stability, because financial panics tend to happen when you break promises to investors. But the areas of disagreement, I think, are also very important. And just putting my own cards on the table, speaking here for myself, I believe that there is a crucial macroprudential justification for the regulation of asset managers. With the end of Glass-Steagall and the move to more market mediation of credit supply, see market mediation, Barbara, not shadow banking, disruptions in asset markets are becoming ever more important both to the solvency of safety net banks and to the supply of real economy credit. There's also increasing correlation and similarity between the financial exposures of dealer banks, hedge funds, insurance companies, and other entities that perform an asset manager function. An argument that's sometimes made against regulation of asset managers is that asset managers are completely passive and simply act as an agent for investors. Even if one believes that, and I don't think I do, it's ever more important for financial stability to understand investor behavior in asset markets. And asset managers are the institutional vehicle through which a lot of investor behavior is planned, coordinated, and executed. I also think it would be foolish to ignore the ways in which asset managers could, there's that word, come to engage in bank-like activities on a large scale. I'm not speaking here about commercial banking with insured deposits, but the comparison would be to the investment banks that were so central to the 2008 crisis, which in some cases look like gargantuan hedge funds. While I'm not suggesting that asset managers are currently engaged in those kinds of activities at that kind of scale, I think it would be short-sighted to ignore their capacity to do so. To those who say that rules governing mutual funds already protect against possible abuses in areas like leverage, or balance sheet investments in illiquid instruments, I would reply that conventional mutual funds are not necessarily the concern here. We've got to look at hedge funds, we've got to look at separate accounts, and also that the framework of regulation for mutual funds actually is somewhat of a prudential framework. It's somewhat bank-like, if you like. And in fact, it shows some of the benefits of prudential restrictions, for example, on leverage and certain kinds of oversight for funds that bank regulators probably are equipped to do. Now, this raises the hot-button issue of the role of the Federal Reserve as a prudential and systemic risk regulator of asset managers. I should start here by saying that I'm very sympathetic to those who warn of the dangers of importing a prudential regulatory mentality into the oversight of asset management. The last thing we would want to do is import the culture of too big to fail and its accompanying moral hazard into the asset management industry. There's also a danger of importing a kind of risk-averse, too-big-to-fail mentality into the oversight of the financial markets themselves. I'm speaking here of the danger of seeing the prevention of financial market volatility as an end in itself. Regulators should not be focused on preventing market tantrums, which is a phrase that's been getting used more frequently recently. Market tantrums that involve temporary spikes in volatility are not really the regulator's business. What the regulators should be focused on preventing broader disruptions in the real economy, which is a different issue. I actually have a toddler right now, and he does frequently engage in tantrums. And the only time I get involved is when it looks like he's about to stab himself in the eye with a pen or break the family china. And regulators should follow that principle as well. At the same time, I think that the Federal Reserve and other prudential regulators do and should have a role to play in asset management regulation. I think the jury is very much still out on whether this role should involve any FSOC designation of individual asset managers for prudential supervision, at least at this time. But I think the prudential regulators need to be involved now in several ways. First, the information being generated by new data reporting and operational risk oversight by the SEC needs to be shared across all key regulators, especially the Fed, the Office of Complex Institutions at the FDIC, and dealer bank oversight at the OCC. The stress testing regime being instituted for asset managers needs to be integrated into a broader stress testing regime of liquidity and capital stress testing at both banks and central counterparties. And I completely agree with what Barbara said about the importance of central counterparties there. And finally, regulators should work toward appropriate consistency in the oversight of similar activities when they're conducted in different entities. That's an issue not just for things like securities lending, but for derivatives valuation, which is enormously different. The derivatives regulation and asset managers management has not caught up to the things that we've learned in the crisis and the new Basel rules that are being made. But I just want to end, and I'm ending, on an optimistic note here. We really have our work cut out for us implementing the agenda that's already been laid out by the SEC and the FSOC. It's going to be a considerable operational and perhaps political challenge. As I said, the information produced in that agenda, if it's properly shared, will tell us a great deal about where to go in other areas. Thank you.
I get to anchor the left side. Isn't that nice? Oh, you want to?
Well, again, thank you all. We are running significantly late, so I will forego saying very much, but just a few quick comments of mine before we take questions from the audience. Paul, I really appreciate you giving me the opportunity for me to plug my one book. I've written a book called Uncle Sam and Pinstripes, Analyzing U.S. Federal Credit Programs. He's essentially proposing another one. So I've sold literally hundreds of books here. I hope we can sell at least a few tens more off of that. But the substantive point I want to make is, while it's an interesting idea, one of the things I always worry about with these programs is even if you get the pricing and structure right at the beginning, all of the political pressures are for you to charge less and less over time and be less and less careful about who you apply it to and spread it out more broadly. So as you think about how to do this, I would strongly recommend thinking about how to provide some structural mechanism for keeping it from getting out of hand, even if you do conclude it's right in the first place. And I will mention, I think Barbara, in addition to a great deal of clarity, had the prettiest colors by far on the presentations. I will definitely have to learn from that. But I think all three of the panelists were very clear in what they said. They have fairly different views. So I will not start a Donnybrook up here among them, but rather, given the time, let me give you about 10 minutes in the audience to ask a few questions if you have some. Otherwise, I'll talk more. So come on, we can do this. And not you. You've got a couple in already. Is there anyone? What else? All right. Then in that case, I'll ask a question, and you guys can think about more. Marcus, I think you and Barbara have fairly different views at this point. It sounds like you believe that there are a great deal of potential systemic risks from asset management, significantly more than it sounds like she does, and I'll give her a chance to speak for herself. What do you think is at the heart of why the two of you disagree, assuming I've correctly characterized that? And I'll give you a chance too, Barbara.
Well, first of all, I think, and this, I sort of structured what I said around areas of what I think are emerging consensus. I think there are actually a lot of sort of practical agreements that we have in terms of what next steps are in terms of what to do, even if there are some bigger conceptual disagreements lurking behind it. I mean, Barbara did seem to be in support of that SEC agenda that's been laid out, in support of stress testing, in support of greater disclosure and information reporting. And as I said, I think those are extremely valuable things, and I think that they're going to be able to inform us in thinking about whether we really do disagree on the other areas. And in terms of the sources of disagreement, I mean, you know, I could sort of re-give an entire speech on that. I think it's just, you know, BlackRock has a $250 billion balance sheet. It would be the 15th largest bank in the United States. It's got access to trillions of dollars in investor assets that it could potentially use as collateral to do a lot of different things. It's got probably the greatest capacity of any institution in the world to develop, or some of the greatest capacity to develop and market complex new instruments and products, and we should remember that, and to distribute them, and we should remember that bank distribution through their CDO desks was of new products through their CDO desks was a very important part of the crisis. And I'm sure Barbara's going to, you know, come in here and tell me why they can't use all the assets on their balance sheet, and they have these restrictions on the use of the assets under management by investors, but especially for stuff that's not a conventional mutual fund. I just think we can't just say that's off limits and that can't create a systemic risk. I mean, I just don't see how you could conclude that based on the knowledge base we currently have and the experiences we've had.
Okay. Barbara, what do you think is at the core of the disagreement?
Well, quite honestly, I didn't think today was going to be a firm-specific conversation, but given the comments made, they do need to be addressed, and facts need to be put on the table. So, just to clarify, my background is I'm a founder of BlackRock. We're 26 years old. I've seen it grow from a blank sheet of paper to what is today $4.5 trillion of other people's assets. The assets you refer to as being on our balance sheet are actually not assets on our balance sheet. There are different accounting conventions, and in the UK, the way insurance works, it shows on your balance sheet, and there's an exactly offsetting liability, and those assets are not available to creditors. So our actual balance sheet is quite small, and I would take exception to what you said. I think Josh said it the best earlier. Questions should be asked. People should get educated. People should learn what the actual information is. We work on behalf of our clients. We manage other people's money, period. Simple as that. We do welcome looking at everything from operational risk to looking at fund structures. We've even written extensively on all of these topics and suggested a number of changes. So it's not to be defensive. It's to put facts on the table, and let's look at real facts and then have a real discussion. Thank you.
I mean, the figure came from BlackRock's 10K, so I'm sure you're completely correct that there are all kinds of restrictions and limitations that make it different than the assets held on bank balance sheets.
I think we should have an offline discussion. This is really not the appropriate place to have that, okay?
Well, I mean, I'm not sure why you would take it personally. If I would note the success of BlackRock in its growth, but I think the investor assets is also an issue. I mean, when you're doing when you're doing things like indemnification for securities lending, you know, the company itself, the company's resources are put at risk, and that's an activity that banks undertake, and that's a bank activity that's regulated one way on the bank side and another way on the asset manager side. So
could I just briefly reply to securities lending indemnification? So people should understand, first of all, we act as a securities lending agent. We are not the actual owner of the assets. We're not lending our own balance sheet. Of the indemnification, where we lend, we only deal with banks that are government-insured counterparties. We don't lend to anybody else. The indemnification we're providing assumes two things. Number one, the counterparty fails. The only counterparties being government banks, government-backed banks. And two, that we take collateral, we over-collateralize every transaction from cash to securities, and the collateral would have to be insufficient. So first, the government-regulated entity would have to fail. Second, we'd have to have a shortfall in the collateral. And then the only thing we're indemnifying is that differential. Let's say we made both decisions bad. Let's say the whole thing blew up. The losses would be the client losses. This isn't a leverage situation. This isn't like a bank. We're not going to go out of business. We have more than enough liquidity to cover any possible exposure. So it's a red herring issue, just like the balance sheet one, which is a misinterpretation or a 10K. Thank you.
Leave it at there. I was afraid of starting at Donnybrook. I apologize. David, you have a question.
David Wessel from Brookings. Barbara, in the first panel, there was a lot of discussion about the extent to which asset managers were just doing the bidding of their investors. And it seemed a little simple to me, and I walked into a conversation between you and Peter Fisher that I want to invite you to share with the audience. What role do the consultants play? What role do consultants play in advising clients, and to what extent are they a mechanism for hurting behavior that we need to pay more attention to?
It's an excellent question. So there's very little understanding of how asset allocation decisions are made. And all of you work at entities where you have a 401k plan. Just think about what's on your 401k list, how those choices were made, who made those. The answer is there's a whole group of consultants. They're called sometimes pension consultants or investment consultants, and they're all over the world. Some of them are quite large in the amount of assets they advise, and they will make a change in their asset allocation model. They'll make a buy recommendation, a sell recommendation on an individual manager. You saw in the PIMCO case recently, lots of money moving. Some consultants said they made a buy recommendation on PIMCO after Bill Gross left. Others said they had a sell recommendation. Some had a wait and see. So the role of those consultants is actually instrumental in understanding asset flows across the industry, both across managers and across asset classes where people choose to change their asset allocation itself. Thank you.
Okay. Can I ask why this has anything to do with systemic risk? I mean, I don't advice and things like that. I mean,
I think the question is, if we're trying to understand why do people tend to move in all the same direction, and we have a very simple model in our mind that doesn't represent reality, if all the consultants say, let's get out of Malaysia tomorrow, it could have a big consequence for Malaysia. So that's the question, it goes to, is there something in the structure of the industry that magnifies the effect of the shock? And I was just asking for an institutional detail.
okay, but this is again just a principal agent problem that occurs everywhere. So either I make that decision myself and all individually we decide to get out of Malaysia, or we have a bunch of consultants we talk to, they convince us to put sell orders on Malaysia. I mean, I don't, it may be something that makes disperses information and makes people think the same way. But I don't know what that has to do with an externality and systemic risk. If everybody wants to get out of a market, in the world I live in, they should be able to sell and get out of the market, and the price will go down. And that's not a systemic risk in the way I view things. That's the market correct.
I think he's getting at the heart of Gaston's presentation earlier. If, let's say, all the consultants recommended getting out of emerging markets and all these clients move their money out of emerging markets into something else, what would happen in emerging markets? Now, I would say that's a question you really want to understand better, the role of the consultants, because it's not the asset manager making that decision, it's the asset owner, and the asset owner usually in consultation with their consultant.
Okay.
Josh actually wanted to have one quick question, Josh.
It may or may not be quick, in which case you'll just defer. I see a couple of basic points about, all right, there is a systemic risk. There was a systemic crisis. Okay. Part of that systemic crisis came from a product which people didn't understand, neither the regulators nor the others. What I'm curious about, Marcus, is the same very intelligent, very well-meaning people who missed CDOs, okay, are the people who you are presuming somehow should catch the next one. And what I'm curious about is, if we move away from the standard disclosure form of resiliency plans towards product regulation, who's going to figure out what the products are, and do you trust them?
Okay. Yeah, let me, well, I feel institutionally bound to say that neither I nor AFR, the organization I work for, has any position on whether BlackRock or any other asset manager should be designated. The only reason that I was using these examples was not to pick on BlackRock in particular, but to talk about how asset managers, but to protest against the idea that asset managers as a class should be ruled out for designation in perpetuity. So that is not something that we have any position on. And the second point I wanted to make was in response to this issue about markets. As we move toward more market-mediated credit, things that happen naturally in markets do become threats to financial stability. It is not a contradiction to say, if we're going to do a lot of real economy credit intermediation through traded markets, and we're going to allow traded markets to structure products that people rely on as money-like and need to rely on for short-term stability of valuation, then stuff that happens naturally in free markets is potentially going to present a financial stability risk. And we have not completely figured out how to handle that, I think. And what happens in markets is extraordinarily dependent on institutional detail. You can see this in what happened to tri-party repo, which triggered off the crisis. You had a market where people were legally forbidden from taking possession of the collateral that was being used for their loans, where there was massive intraday credit exposure that people didn't understand, and where that market was critical to funding all kinds of systemically significant institutions. So, these little details are lurking out there, and they're very important to look at. And in terms of this question, I think, first of all, the separation of you have to look at disclosure and product regulation is linked, because if you allow people completely free hand to define products of unlimited complexity, then disclosure is really not going to help you very much. Whereas if you standardize products, the more you standardize products, the more disclosure is going to help you, I think, and the more you can rely on investor discipline. And in terms of the same people who miss CDOs, it is true that there was not really a fundamental overhauling or change in personnel of the U.S. regulatory system after the crisis, and that was not, I think that you can raise some serious questions and issues about that. Okay,
so let's cut it now. I will say, I'm making an exception for a former vice chair of the Fed here. So Don, if you want to ask a question, okay, then everybody can go home. Thank you all. Thank you all.